Have you ever looked at the interest rate on a loan or maybe an investment and just wondered, what is that number, really? Where does it come from? Well, it's not just some number plucked out of thin air. It's actually a story about time, risk, and what we expect to happen in the future. Today, we're going to pull back the curtain and deconstruct that story piece by piece. Okay, let's get into it.
So here's our game plan. We'll start with the different jobs an interest rate does in the economy. Then, we're going to build one from the absolute ground up, starting with the pure price of time, and then we'll start layering on the real-world stuff, like inflation and all the different kinds of risk. By the end of this, you'll see exactly how a rate gets put together and why knowing this stuff is so powerful. And to get us started, just think about this for a second. The U.S. government can borrow money for almost nothing, but the interest rate on your credit card can be, well, astronomical. Why is there such a massive gap? They're both just interest rates, aren't they? The answer is hiding inside those numbers, and that's exactly what we're going to unpack today.
Now, before we start building, you got to understand that an interest rate kind of wears three different hats. If you're an investor, it's your required rate of return, the absolute minimum you're willing to accept to part with your cash. If you're a financial analyst, it's the discount rate you use to figure out what a dollar you get next year is actually worth today. And for every single one of us, it's the opportunity cost. By spending a dollar today, you're giving up the chance to invest it and earn that interest. These three ideas, they're the engine behind every interest rate out there.
Okay, let's start building this thing. We're going to begin with the most basic, most fundamental piece of the puzzle. This is the starting point for literally every interest rate, long before we add in any of the messy, real-world complications. And that is the real risk-free interest rate. Now listen, this is a purely theoretical idea, but it's absolutely essential to get. Just imagine a perfect world. There's no inflation to worry about, and you're making an investment that has a 0.0% chance of going bad. The return you'd get in that perfect scenario, that's the real risk-free rate. It's nothing more than the pure, simple payment for agreeing to wait.
So the whole point here is that this base rate has absolutely nothing to do with risk. It's just the price of time. Economists call this time preference. It's that fundamental human thing where we'd all rather have a cookie now than a cookie next week. This rate is just the bare minimum reward you need to convince someone to wait for their cookie.
All right, so let's step out of that perfect theoretical world and get back to reality. And what's the very first thing that hits us? Inflation. And it immediately changes the whole calculation. It just makes sense, right? If you lend out $100 for a year and prices go up by 3%, that $100 you get back can't buy as much stuff as it could a year ago. Your money's purchasing power has gone down. So to fight this, investors demand an inflation premium. It's not really about extra profit, it's just to make sure they can break even against their money losing value. And here's where it gets really interesting. When you take our theoretical real risk-free rate and you add that inflation premium on top, you get something called the nominal risk-free rate. And guess what? This one isn't theoretical at all. You can actually see it in the real world. It's basically the interest rate on a short-term U.S. Treasury bill. It's risk-free because the government will pay you back, but now it includes the very real risk of inflation eating away at your return. Okay, so now we have a rate that pays us for waiting and protects us from inflation. But most lending, most investing isn't totally risk-free. So now we have to start adding on extra layers, premiums for all the what-ifs, for all the things that could possibly go wrong. And the first one is the most obvious one, default risk. This is just the straightforward risk that the person or company you lent money to just doesn't pay you back. The shakier the borrower seems, the higher the premium a lender is going to demand to cover that potential loss. It's as simple as that.
And this lays it out perfectly. Lending money to a big, stable government, it's considered incredibly safe, so the default risk premium is basically zero. But what about lending money to a brand new startup with a wild idea? Well, that's a whole lot riskier, isn't it? The much higher interest rate they have to pay is because they have a big, fat default risk premium attached. Next up, we've got the liquidity premium. Liquidity is all about how fast you can turn your investment back into cold, hard cash without having to sell it at a big discount. If an investment is tough to sell, we call it illiquid, and investors are going to want a little extra return for the hassle of potentially being stuck with it.
So, for example, you can sell a U.S. Treasury bill or shares in a giant company in a matter of seconds at a fair price. That's super high liquidity, which means there's pretty much no liquidity premium. But now, try selling a bond from some small, obscure private company. It could take you days, maybe even weeks to find a buyer, and you might have to slash the price to do it. That difficulty is exactly what the liquidity premium is designed to pay you for. And finally, there's the maturity premium. This one's a little more subtle. It's also about time, but in a totally different way. See, the longer you agree to lend your money out, the more uncertainty there is about the future. What if overall interest rates shoot up in 5 years? Well, then your loan at today's lower rate suddenly looks a lot less attractive. The maturity premium is the extra compensation you get for taking on that long-term risk.
A 90-day T-bill versus a 30-year government bond is the perfect way to see this. With the T-bill, you're only locked in for 3 months. Not a whole lot is going to change in that time. But with a 30-year bond, you're locking in that rate for 3 entire decades. So much can happen to the economy and inflation over that time. That huge cloud of uncertainty is precisely why the 30-year bond has to offer a higher rate. It includes that maturity premium.
All right, we've gathered all of our building blocks. We've got the foundation, we've got the real-world adjustments, we've got the risk layers. Now, let's stack them all up and see how we get to the final interest rates we see every day.
And there it is. You start at the bottom with the pure price of time. That's our real risk-free rate. Then you add a layer to protect against inflation. Then you start stacking on the risk premiums, one for the chance of default, one for how hard it is to sell, and one for how long you're tying up your money. Put it all together, and voila, you have a complete interest rate.
This table, right here, makes it all just click into place. Look at the 3-month T-bill. It's got the real rate and the inflation premium, and that's it. No real risk of default, it's super liquid, and the maturity is tiny. Now look at a 10-year corporate bond. It starts with that same foundation, but then you have to add a premium for default risk, for liquidity, and for maturity. This is it. This is exactly why its interest rate is higher. Every single difference between 2 interest rates can be explained by which of these premiums are in the mix and how big they are.
So why do we care about all this financial architecture? You might be thinking, okay, that's kind of neat theory, but this isn't just theory. Understanding these moving parts has a direct impact on your wallet and your financial life.
Seriously, the next time you hear on the news that inflation expectations are rising, you'll know that means the inflation premium is getting bigger, and that's pushing all interest rates up. When you compare a mortgage to your credit card bill, you can literally see the massive difference in their default risk premiums. This whole framework, it's like a decoder ring for the entire world of finance. It empowers you to understand what's really going on.
And that kind of brings us to our final thought. As you look at the economy today, with all the headlines and all the ups and downs in the market, which one of these risk premiums, inflation, default, liquidity, or maturity, which one do you think is the main character in the story right now? It's a really powerful question to ask, and now you actually have the tools to start figuring out the answer. Thanks for watching.